Hello and good day. Today my objective is to take an introductory lecture on securitization. Basically, I'm going to spend time on discussing what is securitization. Securitization is something on which I have been associated intensively over the last approximately 25 years. Besides being an academic, having written books such as That's One I Have in Hand, the thick one, and then also have written books like this, that's Introduction to Securitization with Dr. Frank Fabosi. Besides having written these texts, I've also taught at academic campuses, and more importantly, I've lectured with industry stakeholders all over the world in good days of securitization before 2007 with lots of locations all over the world. However, over the last few years, primarily in emerging markets. And what we today intend to do is to talk about the concept of securitization in a very short introductory video. I'll start with what is, how important securitization is. So we understand the significance of the instrument. This is something which has been largely regarded as being responsible for causing the global financial crisis. I think something has moved the economies of the world and put the world into some bit of a recessionary phase from 2007-8 onwards for almost like 10 years. This is one of the instruments which has been regarded as responsible. The jury is still undecided on whether this allegation was actually correct. But there's a lot of substance in saying that there was a lot of exuberance, there was a lot of excessive leveraging in the market, which was largely enabled by prevalence of securitization practices. So I've got on the right hand side of my screen a quote from The Economist of January 2014, which says, if you ask regulators in 2008, which financial instrument the most wished would have never existed, odds were that they angrily splurted a three-letter acronym linked with securitization, such as SCDO or a CLO or ABS or MBS. But then in 2014, Economist wrote, it goes on, it wrote this way, find the same regulator today and is probably devising a ploy to resuscitate this very financial vehicle as which he was demoning 5 years back. Today we are in 2020, and it's a different scene altogether where there is a substantial disruption caused in global financial markets because of a different kind of a crisis. But in this scenario, it's notable to see that a high-level group of proposing the capital market union for the European Union has actually come up very strongly in favor of securitization and wants and sees securitization as holding the key or partly the key to economic revival from the present crisis. So it's a hugely important instrument in terms of sizes as well. You can see on the left hand side, I mentioned some data, and as you can see in as you can see the data over here. It shows the outstanding volume of securitized instrument is about 11.3 trillion. That's a huge number, 11.3 trillion as of end 2018. I wouldn't say the numbers after 2018 have not been extremely great, but the 2018 data itself is a huge number, 11.3 trillion. And you can also see that 69% of residential mortgage debt in the US is funded by securitization. That's a huge number. 69%, approximately 70% of every dollar that goes into residential mortgage funding in the US comes from securitization. By the way, US mortgage markets are truly very, very intensive, very, very huge in terms of what is called penetration number. US is a very developed mortgage market. And in that mortgage market, approximately 70% of the entire funding comes by way of securitization. So that itself speaks of the massive significance of the instrument. About 70% of all car loans, automobile debt, comes from securitization. Likewise, about 12% of student loans and about 14% of credit card loans come from securitization. In Europe, it's less as strong. region is that in Europe there has existed traditionally another instrument for funding mortgages, and that's called covered bonds of fund brief, on which at some occasion we'll probably have a separate lecture. So in Europe it's not as strong as it is in US, neither equally as strong in the Asian Pacific region, but in the US the market is tremendously used as is indicated by the data. Let's move on to see the concept of securitization. So let's move on further to talk about what securitization actually does, and we proceed to see that briefly the history. It's not something which is very old in terms of history. It originated in 1970. 1970 seems to be the first year where a US government agency, one of the GSEs, one of the US government supported entities, the government has promoted 3 entities over time, the Ginnie Mae, the Fannie Mae, and the Freddie Mac. And Ginnie Mae is believed to be the first one which started the first mortgage pass-through way back in 1970. So we talk about the history of securitization. We are almost celebrating the Golden Jubilee this year, 2020. It would be 50 years of securitization. My lecture is obviously not to celebrate the Golden Jubilee. However, well, incidentally, it happens to be 50th year. And one also sees that the 1970 experiment by Ginnie Mae went on to other US government agencies, the Fannie Mae in 1981 and the Freddie Mac. They also came up with what is now called agency-backed securities. Agencies refer to the 3 US government agencies which are responsible for securitization. The Ginnie Mae, Fannie Mae, and Freddie Mac are referred to. But outside of the agencies, the first non-agency backed transaction seems to have come sometime in 1985 with asset-backed transaction from a computer leasing entity. And then, of course, the market never saw back. It never looked back and continued going forward with accounting standards largely permitting off-balance sheet accounting. One of the early accounting standards was what is called FAS 125, followed by other accounting standards over a period of time, FAS 140 and then FAS 156 and so on. So accounting standards largely permitted off-balance sheet transactions. More importantly, it was also possible under the regulatory standards to gain a capital relief. So off-balance sheet coupled with a possibility of gaining capital relief, plus of course a largely stable financial system with low interest rates, housing prices consistently going up, home loans sounded continuously attractive, and the market kept on. It ultimately got into some kind of a frenzy from the period 2005 to 2000, I would say 2005 to 2007 onwards. Until 2007, the market became into some kind of a frenzied mode because the defaults historically, home loans were very low, and housing prices kept on increasing, thereby enabling a person to invest in a house for the purpose of making a quick equity extraction, making a quick equity gain. Let's not get into history of global financial crisis, that becomes another topic by itself. And in 2007, because of the very excessively high level of leverage prevalent in securitization itself, more so in what was known as CDO transactions, into which once again another leverage entity called hedge funds were investing. So a leverage entity invests in a leverage transaction which itself is built on leverage. We talk about 3 layers of leverage built one over the other, leading to a very substantial extent of leveraging in the market. So in 2007, the global financial crisis hit. Most of these securitization tranches collapsed like a house of cards, and I would say approximately 12-13 years after the crisis, we are still not exactly back where we were before the exuberance of 2007 built itself. It's still, well, of course, regulators now increasingly realize securitization as being helpful, but as such, if somebody says, has the market actually come back to where it was, I would probably say it's possibly not still the case that the market has actually come back. Let's continue to move forward as to what securitization basically is. So literally the word securitize, to securitize. So securitize basically means what? To transform something into security. Something which is not a security, something which is, for example, an asset, is transformed into a security. That's securitization. To securitize is the same, therefore, as to transform or convert something into a security. Now, what's a security? It's a marketable or tradable paper, and marketable instrument or tradable paper, such as a bond or call it a debenture or share. So it's transforming assets into securities. What exactly is transformed? As we'll get to see later, it's not just an asset, but a pool of assets. It's a pool of portfolio of assets which gets transformed into securities. We'll develop this idea a bit further as we go. So securitization in that sense is actually a device of asset-backed or asset-based funding. What exactly do we mean when we talk about asset-based funding? And one could also argue that after all, every funding ultimately has to be paid off from the assets of the issuer entity. So every funding is eventually an asset-based funding. But what distinguishes securitization is that the focus is on specific assets, not on assets of the entity in general. It's a specific claim on a specific pool of assets, identifiable, ascertainable, miniaturized version of pool of assets, so that we are not subjected to the entity-wide risk. So we are narrowing down ourselves in terms of risk, in terms of scope, in terms of the claims of investors on a specific pool of assets. That's what distinguishes securitization from traditional funding instruments. I would also call it a mode of structured finance. This is a very commonly used term, and one would often try to understand what exactly is meant by structured finance. Structured as opposed to unstructured or plain vanilla transactions. A structured finance basically tries to structure a security to align it with investors' needs. So what we do basically is we have a pool of assets, we slice it, carve it, craft it, structure it to make it suitable for specific investor needs. Investor needs defined in terms of risk and returns. Some investors want low risk and low returns. They're happy with low risk and low returns. Some investors are prepared to take higher risk, and therefore they would surely want compensation in form of higher returns. There are some who are so-called bungee jumpers, and they might probably want much higher thrills in life. So they want much more risk and much more rewards. Also in terms of payback periods, there are investors who want different payback periods. There are short-term investors, medium-term investors, long-term investors, and so on. And well, investors may also have different expectations in terms of prepayment. This is a complicated part of securitization world, is prepayment risk. So if somebody wants to be completely limited to basics, one may not get into a prepayment related feature. Let's proceed further. I wouldn't actually want to spend time comparing securitization and corporate finance at this point of time. That's not important as of now. So I'll continue to proceed further and look at a basic process graph that shows the process of securitization. So here we are trying to understand what is securitization with the help of a quick process graph. Right. Let's proceed further. So we are talking about, okay, my graphs are not extremely brilliant, but they would still probably be able to convey what I want to convey. So let's stick to the graph. So originator, I start with originator. Originator essentially is what? Originator is the entity which has originated or created the assets in question, which is what we want to securitize. So what we have in mind is basically a financial sector entity. Am I saying that securitization is limited to financial sector entities only? I'm not saying that, but most of securitization still concerns itself with financial sector entities. So the originator is the entity which has originated or created some assets, loans for example, which it wants to transform into securities. So that's a picture of an originator, which is sitting with a bunch of assets. What sort of assets are these? The assets are mostly, as I said, a pool of loans. So we have obligors or the borrowers to whom this lender, which is basically a financial sector entity, say a bank or a non-banking financial institution, has given loans. So there are cash flows which are coming from the obligors, the borrowers, to the originator over a period of time. To make the example more specific, we might take the example of a home lending, mortgage lending entity. The originator is a mortgage lender, which has given out loans to hundreds and thousands of borrowers. These borrowers are paying cash flows over a period of time to the originator. The originator is now looking at ways of refinancing itself, creating liquidity or getting refinance against the assets. Why do I need refinance? I am a lender. I have to make business of lending. So I need liquidity or money all the time. I need money all the time. I have options for raising money. I can use traditional, what you call, on-balance sheet methods of raising liquidity. For example, I can reach out to depositors for money. I can reach out to bondholders and do a bond issuance. I can probably go to another bank and take a loan from other banks. Therefore, I can tap different methods of raising money which are available to me. For the purpose of comparing securitization, the nearest comparable will be a bond issuance. I would try to compare securitization not with other modes of funding, but with a bond issuance. So I'm a bank, I'm a non-banking financial institution. I could have used a bond issuance to raise funding, but I'm examining the potential of using securitization for raising money. So I'm in the process of securitization. What exactly I'm going to do? I'm going to set up a special purpose vehicle, a special purpose entity. Now this is what I call, it's not a holy grail of securitization. It's not something which is enigmatic or something which is too complicated to understand. But the use of special purpose vehicles in structured finance is ubiquitous. The meaning of special purpose vehicle. Vehicle essentially means what? Vehicle means legal entity or the instrumentality created for doing a transaction. Special purpose vehicle means a vehicle that be specially created for a specific purpose, as compared to general purpose vehicles or general purpose entities. For instance, a normal trading company, a normal trading corporation is a general purpose vehicle and generally gets into business activities. It carries any kind of business activities. You can call it an operating vehicle or business vehicle or business entity. A special purpose vehicle is a passive entity. It does not engage itself in any active operating activity. It's a special purpose vehicle. This vehicle has several specialties, and among the specialties, the important specialties I'm going to say here in terms of specialties of special purpose vehicle, number one, its net worth is negligible. Net worth is very low or almost, it's at a low or almost negligible net worth. Net worth, that is freestanding capital or freestanding net worth, is extremely low. That's one specialty. Second specialty is that there is a prohibition to engage in any business other than enabling securitization. It is formed with the purpose of enabling securitization, so it would have to stay limited to that purpose only. It will not engage itself in any other business. Its net worth is negligible. It is not engaged in any other activity other than providing a template or providing the facade for enabling this transaction. That's all it does in life. It doesn't do anything else. It's simply a passive vehicle created for this little, enabling. It stays as long as the transaction survives. I wouldn't say it would just get lent the very next day. It stays as long as the transaction survives, but it's created for that specific purpose. So I'll call it a special purpose vehicle, at least with the two important specialties. Number one, it has no other business other than simply enabling the transaction, and it does not have any significance. Its net worth is insignificant. It does not have employees. It does not have a large office. It does not have an infrastructure. It does not have computers. Does not have systems. Does not have anything. So it's a completely non-substantive entity. It's a shell by itself. Has absolutely no substance apart from being a legal existence. That's a special purpose entity. I have created a special purpose vehicle. You could probably get further into legalese as to who creates it, who owns it, and so on. That legalese may not be relevant at this point of time. It always might be. It always might interest particularly those with legal background as to who is the owner of the special purpose vehicle. I'm not wanting to, as of now, get into that question. So I have created a special purpose vehicle. What am I doing with the special purpose vehicle? This originator of ours, who was sitting with a pool of loans, he actually does what? This originator transfers. The originator transfers. So the originator who was here, right? So the originator transfers Okay. While we're getting stuck here, seems I'm stuck with this particular screen and not able to move forward. Just give me, let me just stop screen share and come back to it. Maybe no, it's seemingly stuck here. Okay. Right, I stop share and we go back to where I was to see if I can actually get back exactly where I was. Okay, this is where we were. So we were talking about right. So the originator does what? The originator assigns actually the same as transfers. The originator transfers the cash flows to special purpose vehicle. That would mean these loans which were actually sitting with the originator, the loans which were with the cash flows, the loans which were with the originator are now getting transferred to the special purpose vehicle. The loans are, in fact, the cash flows, not the loans, but the cash flows are got shifted to the special purpose vehicle. And next, what we do, there is a trustee who looks after the special purpose vehicle. That's once again the part of the legal design of the transaction. Not very important to talk about who the trustee would be. The special purpose vehicle is the one that goes to investors, reaches out to investors, and issues securities. The securities are issued. The securities, it's all about securitization. So the question is, who issues securities? The special purpose vehicle goes and issues the securities to investors. So who is the issuer here? The special purpose vehicle. The originator is not the issuer. Actually, the originator is the one who has transferred the assets. That's the seller or the transferor of the assets. On the strength of the assets, the special purpose vehicle goes and issues the securities. So the SPV raises money for funding the purchase of the assets, and this money moves on to the originator. So you can see what has happened. The originator was sitting with assets. The originator was wanting cash. The originator sold off the assets to the special purpose vehicle. The SPV goes and issues securities and collects money enough to pay for the purchase of assets from the originator, and thus the money is paid back to the originator. The loans have now been replaced by cash. The originator was sitting with loans. The loans have now been replaced with cash. One could probably say, what is so big about raising cash by selling assets? That's something that we do all the time. I have an old car. I have a house that I don't need. I probably have some jewelry and I'm in need of cash. I go and sell my assets and get cash. So what is so big about selling assets and getting cash? That's hardly a method of funding. That's a mode of disposal of assets. But in a sense here that you would realize, once we are done with the discussion, you realize, actually I have cosmetically transferred assets. I have sold assets actually. Legally I've done a sale of assets, but I've not actually got rid of the assets completely. It's not like selling my house or selling my car or selling my jewelry. It's actually I've retained some interest in the transaction even while selling them. So I'm actually converting sale as a method of into a method of funding. I'm actually using sale as the methodology of raising money. So it's actually a financial device using sale as the process. Right? So we talked about money has come to the originator now. Now what happens over the period of time? Well, what we sold actually were loans. The loans actually will still have to be collected. Somebody has to actually get into the task of collecting the cash flows. So who does the collection? Well, mostly the originator, the one who originated the loans, may also be the servicer. This may or may not be true. It may be a specialist servicer to whom servicing function might have been passed on, but that's not mostly usual. Mostly the originator is the servicer. So the originator continues collecting month on month the cash flows from the obligors. From the borrowers, monthly collections are still handled by the originator. Once again, a legal question could come. Did you at all go and tell the borrowers that the loans have been shifted, loans have been sold? Those questions, once again, are part of legal design. And in this introductory lecture, we may not get into legal details. That would probably be a part of a quick lecture on true sale, which is another term that we mostly use in connection with securitization. So month on month, the cash flows are collected by the originator as the servicer, and the originator passes on the cash flows minus his servicing fees to the special purpose vehicle. Now, the transaction may absolutely be a clear pass-through transaction. Pass-through meaning whatever is collected by the SPV is passed through to the investors through the SPV. Pass-through. That would mean whatever is collected without doing any tinkering, without doing any reconfiguration, without doing any tweaking. Whatever is collected month on month is passed through. But sometimes what we also do is to do a minor reinvestment of the cash flows. Sometimes we also use a liquidity buffer. We create some kind of a cash collateral or a liquidity facility to even out the cash flows. Because you might easily realize that month on month, what we collect every month, irrespective of how good the borrowers are, they could still be monthly fluctuations. Because a particular month the borrower did not pay, some borrowers did not pay, some borrowers did not pay for 2 months, and then they paid everything in the 3rd month. There might be monthly fluctuations in the cash flows. So in order to even them out, in order to smoothen the monthly fluctuations, quite often we use some kind of a liquidity buffer into which we might put some, what I call excess spread. I'll be introducing the term shortly. We put some excess spread and create a cash collateral. So we might do a temporary reinvestment into a cash collateral. And when we need the money, we actually might use this cash collateral. We draw from the cash collateral to smoothen the cash flows. And that's how the payments go to the investors. Now you would still be left with some residual cash. I'll be talking about that as well in a numerical example. This residual cash flows back to the originator. See, item number 10, the residual profit, the leftover profit, this might go month over month, or this might, mostly it would go month over month, or it could go at the end of the entire tenure of the transaction. That's less likely. It would mostly move month over month. The residual profit flows back to the originator. Now, the most interesting part of the securities issued by the SPV is that the securities are not unstructured or just one single class of securities. The securities would mostly have multiple classes. So these securities would mostly be multiple classes of security. That's the most important part of securitization. And I would therefore want to introduce that particular, the classification or the stratification of liabilities into, with the help of a numerical example, and then I move on to the crux of what I call structured finance with little more of basic understanding of the distribution of losses. It's all about tranching, it's all about creating classes or strata of liabilities. Structured finance is all about creating a stacking order, all about creating a renting or stacking order of liabilities, and that therefore forms the heart or the crux of securitization. I'll be discussing that in the next couple of minutes. Before that, let's take a quick example to numerically illustrate what we just discussed. So let's assume that the originator in question had a total of 1,000 home loans. By the way, the aggregate balance sheet of the lender will probably be having tens of thousands of loans. We are not selling all the loans. There are lots of loans in the balance sheet. We're not selling all of them. We identify, let's say 1,000 home loans that would be sufficient to give me the money that I'm wanting to raise. I'm obviously not wanting to raise, I'm not wanting to sell the whole of my book. So I identify some loans. Now you might probably also have a question, how exactly do we identify? Now that itself requires detailed answer, and I would like to skip that question right now. We selected doesn't mean by cherry picking. We did not select the loan as if we pick up cherries, so it's not cherry picked loans. We selected loans using some filters, some identifiers that we agreed to, that they agreed would be relevant for our purpose. I'm aware that I'm making it less transparent, but for the sake of simplicity right now, let's be happy with that. So I selected 1,000 loans. Let's say the outstanding principal of those 1,000 loans aggregates to 100 million. That's the kind of funding that I'm wanting to raise. I'm right now looking for raising 100 million. So I identified 1,000 home loans aggregating to 100 million. These loans carry rates of interest of different rates of interest. Let's say the average, I use the word weighted average. The weighted average rate of interest of the loans is assumed 6%. And the loans have different remaining maturities. The loans have been there on the balance sheet for some years already, some months or some years. I would call that the seizuring period, holding period or seizuring period. The loans have been on the balance sheet for some time. That's called seizuring or holding. The remaining maturity on an average is 50. I'm sure you understand that different loans will mature over different remaining maturities. But I'm just looking at the weighted maturity to illustrate the point I'm trying to say. The weighted maturity is say 15 years. Now I talked about the three classes of liabilities that the SPV issues, the three classes of securities that SPV issues, classes A, B, C. Let's put some numbers. Let's assume that class A, which is what exactly is meant by class ABC. That's also important to see what's exactly meant by class ABC. But let's right now see the respective sizes of classes ABC are 96 million, 2 million and 2 million. So we're adding up to 100 million, split into three classes. Class A 96%, that's 96 million. Class B 2 million, class C 2 million. I put also the rates of interest for the respective classes. You can see a kind of increasing order there, but that will also become transparent the moment we discuss the remaining part of our discussion. So if the coupon rates are 4, 5 and 7% respectively for 96%, 2% and 2% of the liabilities, the weighted average by the way will be 96 multiplied by 4% plus 2% multiplied by 5% plus another 2% multiplied by 7% adds to 4.08. The loans, therefore, having outstanding principal of 100 million are sold to the special purpose vehicle typically at a price of 100 million. Normally, the sale to the SPV happens at outstanding principal value. We might get into a complex question of fair valuation, but typically let's assume the fair value and outstanding principal value is the same, 100 million. The loans are sold for 100 million. The originator agrees to act as a servicer. Post the transaction of sale, the loans would still have to be serviced. And let's assume the originator agrees to act as a servicer at a servicing fee of 25 basis points, so 0.25%. So that's the same. We are collecting interest of 6%. Month on month, I'm not collecting interest only. I'm collecting interest as well as principal. But I'm looking at interest for a minute. Month on month, I'm collecting interest. The interest is 6%. The interest 6% comes from here. The weighted average rate of interest is 6%, from which I pay off a servicing fee of 25 basis points to the servicer. I'm left with 5.75. From that, I pay 4.08%, the weighted average coupon over here, and I'm left with excess spread or the excess residual interest, that is after taking care of expenses. I'm still left with 1.67%. This is exactly what in the previous graph I was showing flows back to the originator. And I said mostly it would flow back month on month, subject to creating a cash buffer, which also I was showing in the previous graph. I might create a cash reserve or cash buffer to act as a smoothing agent for the cash flows as they occur. But this 1.67% continues to flow back to the originator month on month. We still have to understand a very, very important part of this transaction structure, which is what is behind this classification of securities into class ABC. So since I say there are three classes ABC, this also means that there is some kind of priority order. As the names indicate, class A seems to be the senior class. Class B seems to be subordinated to class B, class A. And class C seems subordinated to classes A and B both. So in terms of ranking order, I would say class C is the junior most. And then class B is the mezzanine class and class A is the senior most class. So what is the meaning of the seniority order? You can see, first of all, when it comes to paying the coupons, before I pay any coupons to class B, I'll first pay the due coupons, accrued coupons of class A. Whatever is the coupon payment to class A, I'll pay that first. And then I go and pay coupons to class B. And finally, with the remaining cash, I pay coupons to class C. Remember, the special purpose vehicle was an entity without any money of its own. It did not have any money or any capital of its own. It was a blank entity sitting with no pile of cash. So all that SME can do is to pay from the collections from the underlying loans. So month on month from the loans we collect this interest, and that's exactly what we pay to the investors. If in a particular month I don't collect, or I collect less than what I'm expected to pay, I will not be paying it, because what I do basically is I'll first pay to class A, leave class B dry if I don't have enough money. Then I'll pay class B and leave class C unhappy if I don't have money. And if I have money, then I'll pay class C, and the remaining cash goes to the originator. Now think of, let's say some loans go bad. Some of the loans go bad, as invariably in any pool of loans, some loans will default. So loans have defaulted. That leads to a write-off. If some loans have suffered a write-off, who will take the write-off? Obvious enough, since class C is the junior most of the securities, class C takes a write-off first. That would mean the first dollar of loss goes to class C. Class C gets a corresponding write-off as loans are written off to the extent of, let's say, the first loan going bad. And then as loans keep going bad over the term of the 15 remaining years, we keep on allocating the losses to class C. That would mean we keep on writing down class C to the extent of losses realized. Till what point, till what extent do we keep writing down class C? Well, till class C is completely dead. We continue to eat class C till class C is completely eaten up. That would mean to a maximum extent of $2 million, we keep allocating losses to class C. When we have a loss exceeding 2 million, that's when we start nibbling into class B. We start eating class B then. And we continue to eat class C till the losses aggregate to 4 million, because 2 million class C, another 2 million class B, that's total of 4 million. It's only when the losses exceed 4 million that we have any loss going to class A. So can I therefore say that class A is protected by the existence of classes B and C? Class B is protected by the existence of class C. In other words, class A is getting combined strength of the thickness of the existence and the thickness of classes B and C. The more thick classes B and C were, the more would be the protection available to class A. So essentially what we're doing basically is we have a ramping up structure of the liabilities here, where existence and size of class C makes class B safe. The existence and thickness of class B makes class A safe. So basically the safety, security, or the credit quality of class A is a function of the existence and the thickness of classes B and C. This is what in securitization parlance we'll call it credit enhancement. Credit enhancement or credit support, that's a term that we commonly use. Credit enhancement or credit support, very, very commonly used word, credit enhancement. What are we doing basically is that we are enhancing the credit. We are enhancing the credit or enhancing, supporting, uplifting the credit of class A by using subordination as a mode of credit enhancement. By the way, there are several devices, there are several things we can do to uplift the credit quality of class A. Class A is what our objective or what our instant objective in the transaction is to be able to issue class A with the best of rating. Coming to the question of rating now. Our objective is to reach the best acceptable or the best available rating for class A. Therefore, to maximize the rating in the credit strength of class A, we deploy class B and C as the instrumentalities to achieve that objective. Objective is to achieve the best rating, that is AAA rating, mostly AAA rating for class A, and we reverse engineer the sizes of class B and C so as to be able to reach there. How much class C do I need so as to get the desired rating of class B? And how much class B do I need so as to get the desired rating of class A? So our objective is to get the desired rating of class A, with which classes B and C are the means to achieve that end. And in order to get the desired rating for class B, class C becomes the instrumentality. So each of these classes successively become the instrumentality to achieve the desired rating of the next successive classes. That's our objective in this structuring exercise. That's very important to understand the next piece, which is I would call the most important piece of this entire exercise, is to understand the principle of structured finance and to understand what is this probability distribution all about. This curve, the so-called probability distribution curve, this curve is mostly reflective of the distribution of losses in a pool of loans. I'm using a term most commonly used in securitization business, pool of loans or a portfolio of loans. Remember, we cannot do securitization with just one single loan, because one single loan we don't have this kind of a distribution of probabilities. We can do this only with a pool. And the moment we talk about a pool, we also need to say that the pool has to have a reasonable degree of diversification. The pool has to have a reasonable degree of diversification. It's a pool consisting of diverse loans, diversified loans. Retail loans, for example, home loans are presumed to be diversified. Now, home loans, of course, are correlated to housing prices, but that's what we mostly call an external correlating factor. But internally or between borrowers as such, we presume that there is no correlation when it comes to retail loans. But if it's a pool of corporate loans, in order to justify this kind of tranching, the tranching or slicing that we're going to just see, the pool must have a reasonable degree of diversity or diversification. In absence of that, we'll never have this kind of portfolio probability distribution to be able to achieve the slicing that we are trying to target at. So the point we're trying to say is that if you've been able to make this kind of a probability distribution, this is not simply a hypothetical mathematical exercise. We need to look at the past history of losses. We need to see reasonably deep enough in the past performance of similar asset pools, some kind of history of losses, based on which we draw up the probability distribution. This is a statistical exercise. I mean, I would say statistics obviously has a bunch of fallacies, but subject to that bunch of fallacies, it's not so difficult to project the future based on a past performance. Of course, in any statistical forecasting, the limitation always is that we presume the future is going to be similar to the past, because that's the only way we can look at the future on the basis of past experience. But let's leave that limitation for the time being. Let's assume that we've been able to draw up a probability distribution which shows that there's the possibility of getting a 2% loss is something like this. Let's say here, the probability of getting a 4% loss is, let's say, somewhat here. The probability of getting 6% loss, that would mean out of 1,000 loans, 6% goes bad is somewhat here. The probability of getting 8% loss is, say, here, and the probability of getting 10% loss is here. Thereafter, you have this curve almost meets x-axis. It continues to join almost x-axis here. This curve becomes absolutely extremely fine tail and ultimately joins x-axis. What we're therefore trying to say is that looking at the past data, it seems unlikely. It seems very, very unlikely that the losses will exceed 10% of the total pool. Now, what are we trying to actually aim at? We're trying to get a AAA rating for Class A. For the CDMOS class, we're trying to get a AAA rating. AAA rating basically means what? AAA rating basically means a very low probability of loss of principal or loss of interest on that security. Very low probability. For instance, let's take 99.98% as the probability of performance or probability of repayment as well as payment of interest to Class A. What I'm therefore trying to say is that 99.98% chances are that we will be able to pay principal and interest on Class A as per the expected schedule. In other words, we are still leaving a probability of 0.02%. Nothing except government securities. In world of finance, nothing except government securities is presumed to be free of risk of default. So the default probability we are assuming for a AAA security is, say for a minute, 0.0. This is something that comes from rating agencies' past universe of what we call rating transitions. But let's put that number as 0.02. That would mean, if looking at the size of enhancement I have a 99.9% comfort that the losses will stay limited to the extent of credit support I had in the transaction. In that case, the rating agency would be happy to assign a AAA rating to the securities. Now, if you back up this with what we seen earlier, we said the securities, the loans have already been shifted from the originator to the SPV. In other words, irrespective of what the rating of the originator is, originator's rating does not bother us. Originator's rating does not bother us for the simple reason why? Because the loans are no more with the originator. Loans have been shifted from the originator into a separate vehicle that we call the special purpose vehicle. So if the originator defaults, so be it. I am not affected because the loans are not sitting in the originator, the loans are sitting in the special purpose vehicle. I am concerned with the risk of default of the loans. I am not concerned with risk of default of the originator. So irrespective of what happens to the originator, I have a bunch of loans. I am, however, concerned with the risk of default of the loans. That I have analyzed statistically, and my curve, my probability distribution curve in this example, it shows that the chances of more than 10 or more than 11 or more than 12%, looking at the shape of this curve, I can probably see, let's say, look at more than 10, more than 12% risk of default. See if 12% number is somewhat here. More than 12% risk of default is extremely low, and say we still have a 99.98% chance that the losses shall not exceed at 12% level. So in that case, what am I therefore saying? I need a 12% support in order to give a AAA rating to class A. The AAA class A, needs our support of 12% to assign it our AAA rating. Where will this 12% support come from? The 12% support may come from subordination, that would be combination of classes B, C, D, E, whatever classes you have. It can either come from there, or it may come from other forms of enhancement. For example, over collateralization. That's just another form of credit enhancement. It can come from over collateralization. It can come from other possible forms, but largely subordination and over collateralization are the two forms of enhancement available to protect class A to the extent of 12%, which is what is required to attain a AAA rating. So we already got 12% as the size required for attaining AAA rating required for class A. Now let's move to the next class, is class B, for which the desired rating is AA. Now for AA rating, we need a certain level of protection again. It's not going to be as high as 99.98. It's probably going to be say 99. In other words, we should have so much of support for class B that the probability of losses getting limited to, and what is the desired confidence level for class B, is equal to say 99%. In other words, if 8% support, that is the chances of losses being limited to 8% is 99%. 99% probability is that the losses will not exceed 8%. In that case, I can say 8% support, 8% credit enhancement or 8% support will enable me to give a AA rating to class B. But that 8% support once again comes from combination of C, D, and E. Now, similarly, continue slicing back. Let's move to class A. Class A will need once again a desired confidence level, which probably would be something like 98%. For that, let's say I'm happy with 6% enhancement, 6% support. Then I move on to class D, for which desired rating is BBB, and say the enhancement level required for that is 4%. At this point, I have come to the end of the spectrum when it comes to those securities which can be sold off to external investors. I'm assuming from my understanding of the market that the market does not have investors willing to buy something less than BBB. I cannot slice it therefore further. So I'm left with the 4% piece from 0 to 4% here, the 4% piece for which there is no buyer, and because there is no buyer, therefore I am the one who is going to retain it. So the originator retains the 4% tranche. I can therefore now say, complete the picture, the originator has retained the first loss class, in this example that's class E, with a size of 4%. You can also see in the probability distribution that 4% is quite significant. It's nearly taking half of the expected, and some part of the unexpected, in fact most of the expected losses and some part of the unexpected losses also. Expected loss versus unexpected loss. Once again, a very important term in risk management. We may not be getting into details of that, but I'll just state it quickly. The originator has retained most of the expected losses and maybe some extent of unexpected losses as well in form of the first loss class or the equity tranche of the transaction, which is class E in our graph here. That's what the originator has retained. In addition to that, in terms of returns, the originator has also retained that excess spread, which will flow back after paying the coupons to classes A, B, C, D, and of course after paying the servicing fees. So after all expenses are taken care of, the excess spread will continue to flow back to originator. So in terms of risk, the originator is retaining risk to the extent of class E, retained class with the originator. In terms of returns, the originator is retained the excess spread, which will continue to flow back to the originator. The slicing or the tranching of risk into several slices. You can see the safest here is class A, which gets a AAA rating. The AAA rating is not I said there are two things which are backing up the AAA rating. Number one, originator independence. The fact that the transaction is independent in terms of credit risk by way of the sale of the assets from the originator to the SP. We prefix the term and call it true sale, which becomes important to ensure that the transaction has become bankruptcy remote. Bankruptcy remote basically means insulated from the bankruptcy risk affecting the originator. This transaction is a bankruptcy remote transaction by virtue of the true sale, whereby loans were shifted to an entity which is insulated from or protected from the bankruptcy risk of the originator. That would mean we can now disregard. We are not completely disregarding though, but we can largely gloss over the rating of the originator while rating the securities. In other words, we can focus on the risk of the assets alone. When we focus on the risk of the assets alone, we are focusing on the probability distribution, which shows that if we have reasonable degree of credit enhancement, then some of the securities, at least the bulk of the securities, can still get a AAA rating. And that is exactly what our objective was. We were trying to get the highest rating for some of the securities. We've been able to attain that. So if you talk about what are the major merits of securitization, A, it enables us to reach a AAA rating irrespective of the rating of the originator. That's one of the most important attributes or one of the most important merits of securitization. Secondly, I would say, in this example, as you can see, the retained class with the originator is only class E, which is 4%. So I've been able to get a funding of 96 million by putting 4 million into the transaction. I put in $4 million of my own money and I extracted funding of 96 million. So in terms of, if you can try to see, if I put in equity of 4 million and I'm able to get external funding of 96 million, that translates into a substantial leverage. 96 by 4, almost like 24 times. I've been able to leverage my equity 24 times over. So in terms of leveraging ability, it has much greater leveraging ability because the capital that is required for supporting a securitization transaction is much lower than the capital that would be required for supporting any other on-balance sheet funding method. So that would be the crux of a securitization. I would not be spending a lot of time discussing more fundamentals here. I will just quickly end up this discussion by quickly introducing some terminology, which is very, very commonly used. So different types of asset-backed classes. As I mentioned, mostly securitization is done in the world of finance by financial entities, mostly banks and non-banking financial institutions. And the loans which are securitized could actually be loans against mortgages. Mortgages basically might mean either residential mortgages or commercial mortgages. And therefore, the securities that respectively come out of these pools of mortgage-backed loans could either be residential mortgage-backed securities, securities which are backed by pool of residential mortgage loans, or securities backed by pool of commercial mortgage loans. Commercial mortgage loans as in office properties or shopping malls or warehouses or healthcare properties and so on. So that's the NBS world, consisting of RMBS and CMBS. In contrast with NBS, We normally might call it ABS, that is asset-backed securities, consisting of different types of retail loan pools. Think of car loans, student loans, SME loans, MSME loans, personal loans. These are all pools of retail loans. There might also be corporate loan receivables, corporate exposures, and this is one of the three-letter words that we talked about when we started the lecture. CDOs, collateralized debt obligations, was quite a dirty word during the 2007-8 financial crisis. Collateralized debt obligations is basically a bunch of corporate debt exposures securitized into securitization transaction. So that's CDOs. And one interesting extension of the device of securitization is to securitize the operating revenues or the residual cash flows of an entire business. This device is sometimes called whole business securitization. Whole business, the entire business has been securitized. That would be the operating revenues of a business. Mostly the businesses are those which don't require too much of performance. The business is already ongoing. The business itself becomes a kind of an asset which generates revenues over a period of time without too much of performance. The business starts giving cash flows over time. That becomes a case of whole business securitization. There might also be future flows, future revenues from an existing infrastructure. For example, toll revenues, one example, or royalties. I have an asset which continues to give cash flows over time. Say toll revenues out of a infrastructure facility that also can be securitized. On the right hand extreme, we have a completely different type of transaction called risk transfer or synthetic transactions. These don't result into funding. That's not a funding method. It's basically a risk transfer device whereby risk of different assets, it could be credit risk or insurance risk or weather risk or mortality risk or access, it could be different types of risks which could be packaged into securities in form of risk transfer transactions. I think that is a short introduction to securitization. This is going to form a part of a series of lectures. I'm going to maybe think of spending more time discussing similar introductory lectures. So be on the lookout, join our channel, subscribe to our channel so that more such lectures can be into your computers shortly. In the meantime, have a nice time and thank you very much.